Well, howdy there, folks, and welcome into this video. This is probably one of the most confusing times to be an investor in the stock market or an investor just in any asset, to be quite honest. Probably one of the most confusing times we've seen in the past 10 or 15 years. And what I want to kind of take you guys through is kind of my advice to all stock market investors in the market right now, or just investors in general. Because what you're hearing is a lot of conflicting data, a lot of confusing stuff. And when you're hearing all this, it's very important to understand a few things and keep to a few core principles in this sort of market. And I'm sure you guys saw this. It's a #1 trending thing on CNBC. I talked about it in a video earlier today. Jamie Dimon all of a sudden coming out of nowhere saying, brace yourself for an economic hurricane that's coming, essentially, right? He says, you better brace yourself, Dimon told a room full of analysts. JP Morgan is bracing ourselves. We're going to be very conservative with our balance sheet. And, with Jamie Dimon, this whole situation, right? It sounded like he was almost more bullish just a very short amount of time ago. And also talking about we got an economic hurricane coming. It's very, very scary, right? And as an investor, you hear something like that and you're like, okay, this is the most important bank in the world, JP Morgan, and this is a CEO that's very respected on Wall Street, all of a sudden saying this. Okay, I better brace myself for an economic hurricane, right? And to that I say, Mr. Dimon, you're a little late, man. You should have been preparing for a recession back in January, right? When I put out that video and I, went through how all my businesses I was cutting way back, and I think he might be a little late to that game. You're seeing the Bank of America CEO, Brian Moynihan, as they call him, basically saying there's going to be no slowing of the U.S. consumer from spending money. Nothing will slow the U.S. consumer from spending money. That's like famous last words right now. What's going to slow them down? Nothing right now, he says. From, once again, one of the other biggest banks in the world, the CEO, right? Here's the deal. Yeah, nothing can stop consumers until inflation eats all their money and people start losing jobs, right? And layoffs come and those sorts of things. And so definitely things can stop the U.S. consumer. And it happens rather quickly, no different than Jamie Dimon can go in a very short amount of time from sounding much more bullish than bearish to all of a sudden, talking about we got a economic hurricane coming. And so when you see this, it just causes a lot more confusion for investors out there. Like, should I buy stocks? Should I not buy stocks right now? Like what should I do? Any asset in general, right? People are looking at this. And also I say to this, if you're going to say, nothing's going to slow the U.S. consumer, well, look at probably the two most important companies in the United States of America if you want to get a gauge of the U.S. consumer. There's probably three core companies that come to mind whenever I think about the U.S. consumer. And what have those companies told us very recently, okay? Let's talk about two of those three companies here. The first one is Walmart, right? Well, Walmart stock's down 17% in the past 1 month, almost 18% in the past 1 month. And Walmart had weakness in a lot of categories, guys. And I mean a lot of categories. Walmart had a lot of weakness. And Walmart is the core U.S. consumer at the end of the day. It's like, that's who the heck shops at Walmart? It's the core U.S. consumer, right? And if Walmart, is being hurt in a situation like that, and they just had inventory skyrocket to the moon, right? Like 32%. Here's why this is a problem, and I explained it for the folks under that maybe watch Millennial Money. You guys got to hear me kind of explain this, but here's why this inventory problem is an issue, right? Is if you're a company and you have way too much inventory, well, guess what? You don't need to order a lot of inventory for quite some time, right? Which means those other companies that supply that inventory, right? And I gave an example on Millennial Money, like let's say Walmart orders 100,000 grills and they only sell 10,000. Well, now they got 90,000 grills to either try to discount and sell through. That could take 6, 12, 18, 24 months to sell through all that inventory, right? So which means the company that's making those grills also doesn't have those orders coming in, right? And if they don't have those orders coming in, those workers don't have work. And then come layoffs, hour cuts, things like that ultimately, guess what, hurts the U.S. economy. And so the fact is, when you have somebody like a Walmart basically putting up those type of horrible numbers, it means the U.S. consumer is not doing that well, right? And then there was a lot of belief like, oh, maybe it's only Walmart. Maybe it's only Walmart that's hurt. And then we had Target come out and say, no, we're even worse. Their inventory problem at Target's even worse, okay? They got even a bigger problem. The only thing that's pretty much good for Target's business right now is food and drink and makeup. beauty. And so the rest of the business is not in a good place. And they stated that, right? They stated that if you listen to a conference call at Target, you heard where their business was strongest and where their business is weakness, right? And here we are in the situation where, like, the United States is what shops at Walmart and Target. Like, everybody shops there. And so if you hear Walmart and Target basically having some not so great numbers, and then you tack on Amazon, if you saw Amazon's numbers from the e-commerce side, it wasn't like, oh, was that very exciting? But everybody said, well, with Amazon, everybody kind of gave Amazon a little bit of a pass, even though that stock's been hammered just as bad as those, if not worse. A lot of people looked at Amazon, they said, well, everybody's going out into the world again, not just shopping on Amazon. Well, Walmart and Target said, nah, it's not looking so good for us either, right? And so this is just kind of the tip of the iceberg that we're going to get into in this video, essentially, where I'm going to explain a lot of what's going on here and my advice to all investors out there. I want to first shout out FTX US for sponsoring today's video. As always, FTX US, if you haven't downloaded it yet, do so with the pinned comment down there and use referral code Holy Smokas. FTX US is a phenomenal place where you can basically set up your account to do recurring buys. So let's say you want to buy 10, 15, 20, whatever dollars worth of your favorite crypto each week. You can easily set up recurring buys on there. And right now they actually have an amazing offer, right? Not only do they always have among the cheapest fees you're going to pretty much find out there from crypto exchanges, but also right now, any trade over $10, you get a free coin. And by signing up with my pinned comment down there and using my referral code, Holy Smokas, basically you can get up to $100 in crypto free. So that's pretty darn awesome. So definitely check out pinned comment, utilize that. And FTX is an amazing platform. You guys probably know them from Steph Curry, Tom Brady, Jeremy Lefebvre, and Millennial Money as well. They're the official sponsor of Millennial Money as well. So definitely check that out. Take advantage of that before it ends, guys. That will be pinned comment down there. Alrighty, so Toll Brothers and the home builders, they reported great numbers when it comes to home deliveries, average selling prices. But where people get this wrong is they look at these numbers and they think that means, the housing market is doing so great. Well, all along, these orders of these homes were placed 12 months ago, 15 months ago, 20 months ago in some of these situations. And I live in a community where there's a lot of homes being built. And a lot of these people ordered these homes back at the end of 2020 and in 2021. They didn't order these homes recently. And if you've tried to build a home, especially in a bigger home in the busier markets, you're talking about a 9 to 15 month time frame that you have to wait, essentially. If you only get 9 months, like you're doing well, right? And so everybody sees these home numbers and, some folks got excited about that. And it's like, don't get very excited about real estate. Don't get excited about real estate. I'm just telling you that much, because all these numbers you're seeing in front of your face right now, this is all old news. What we got to know is what's going on in June of 2022 for home orders coming in. I don't think they're very strong based upon many various things I look at. July is probably going to be worse. August is probably going to be worse. And I don't think this is going to get better. I think it's just going to continue to get worse throughout 2022. And we haven't even discussed the possibility of job losses, of layoffs, things like that, right? If you had on that, oh my gosh, then you're just in a huge disaster. But basically, a lot of inventory starting to flood the market. A lot of folks are trying to sell homes before the probably crash, where prices are going to go down substantially, and they're already starting to go down. The amount of price cuts is skyrocketing right now. And we're just at this, we're in like the first inning. We're in like the first inning of this. It's just going to get worse, in my opinion, throughout this entire year. And then we'll see what happens in 23. I'm only going to predict as far as this year goes. And so this isn't a good situation at all for any of the home builders. So you can't get excited about that, right? I mean, the 10-year, this is a 6-month chart of the 10-year. The 10-year is what moves mortgage rates for the most part, okay? And the 10-year is over doubled in the past 6 months. Guess what else has also over doubled in the past 6 months? The 30-year. Right? For a 30-year mortgage, that is. If you want to get a 30-year mortgage, that's over doubled in the last 6 months. And same thing with the 10-year. And so, when does this slow? I don't know. Probably not for a bit. The Fed's obviously hell-bent on continuing to raise rates. It's not a good thing for the 10-year, which isn't a good thing for mortgage rates, okay? And so this is very, very important what I'm about to explain to you. The housing market is, at its core, driven by two big factors. People have jobs, right? Feeling confident about their financial future, and interest rates. For instance, if the mortgage, if a 30-year mortgage went to, let's just say some unrealistic number, 20% tomorrow, no homes would move. Like, it would be a crash immediately. Like, there's just no question about that. So every 1%, essentially mortgage rates go up, it makes the housing market worse and worse and worse and worse. Never mind that, once again, if you can tack on inflation onto people and then potentially job losses that could be coming in the back half of this year, it's an ugly situation. And so there's really nothing to be excited about real estate wise anytime soon, in my opinion. In all this, I hear all this stuff about, oh, we've underbuilt and you got to fill. No, that's all a bunch of BS, man. What ends up happening at the end of the day when the economy gets a little tough, people move in with people, and all the needs that you had for all these extra homes go away. People consolidate. A lot of people have way too many properties. A lot of people I know have way too many properties. I have way too many properties. That's why I'm trying to get rid of one right now, and I'm hoping that baby sells because I'm trying to get out before the crash comes, man. I don't know how much of a crash it will be, but it's not going to be a pretty situation for the next couple of years, in my opinion. And so, when I look at that, I'm just like, ugh, I don't see that getting better anytime soon when it comes to real estate. Now, inflation rate, right? Here's the thing. The Fed way underestimated how much inflation is going to go up. Like, this is one of their core jobs, is to try to basically moderate the rate of increase of inflation. We did not mean to do that. And here we are in the situation where inflation went to ridiculous numbers. Like 5% is high, 6% is really dang high, 7% is unacceptable, 8% is just silly ridiculous, right? And so you look at this, and one side of you says, okay, the Fed way underestimated how much inflation was going to, essentially go up. Who's to say now they're going to perfectly time this thing on the other side as they're raising rates? If anything, they're going to probably go way too hard, way too heavy. They're going to crash the economy or put the economy into a bad situation. Unemployment's going to go up a ton. And then they're going to try to save things by getting the printing machine back going again, right? Then our debts are going to climb again. And you got to understand, once they get the printers going again, as they say, it takes a while to get that money out there in the system. And so then you've got a problem on your economy for a 6, 12, 18-month span, right? Before things start to really recover. And, we saw this play out, obviously, in 2009. The stock market bottoms in around February, March of 2009. The economy was still a mess for at least another year or two because it takes a while before that money actually affects the economy in any positive way. And so the economy was a disaster still until like 2011, and then things started to come back to life a little bit, right? So, these are some things to kind of consider when you're looking at all this, right? Now, the good news is the inflation rate is starting to fall. That's great news. The bad news is we're coming down from 8.5%. So until we get to a good number, which a good number is 3% or lower, it's going to take some time, man. And you guys know me. I'm fully in the belief that inflation is going to continue to come down throughout this year. But gosh, man, we have so far to go. we're coming off 8.5%. So to get down to 3%, we're talking about it's going to take some flip and flapjack in time. And, to make matters even worse in this situation, the price of oil is screwing us so bad it's ridiculous. This is a 5-year chart of crude oil, okay? And thank you, oil, for just screwing us more. And obviously, oil's gone through the roof. I mean, look at a 5-year, it's pretty much the highest we've seen in 5 years. And right around the highest we've seen since actually, the 2008 crash. And so, oil's not working in our advantage. This is something that hurts everybody. This hurts transportation costs. And truckers are already getting hit from a lot of different angles, and I think trucking is going to get worse too. That's another problem. You obviously have oil prices going up. It hurts consumers because most people don't have EVs. The high majority of people still drive internal combustion engines, and so now they're having to pay $5.50 a gallon. Yeah, it's less money you have to spend at the restaurants and the mall and this place and that place, right? And this is just a situation that it's good for almost nothing other than oil and gas stocks. That's about all it's good for. And for the oil industry, which is a small amount of the economy, for everybody else, it's a bad thing. And so, this is, and also it's bad for the inflation numbers because obviously it makes inflation look even worse, right? So ultimately, almost nobody benefits from oil going up. Like, that's just bad, right? Now, the next kind of issue we have on our hands, Apple stock's already started getting hit this year. It's down 18%. I'll be honest, I think Apple could go down 40, 50%. Am I going to short Apple stock? Heck no. I can't do that, man. Apple's too dang good of a company, and they have pulled so many rabbits out of their hats over the years. But I mean, if Apple at some point this year is down 40 to 50%, I wouldn't be surprised at all. And we're going to go over their numbers here in just a moment. But I'll just be honest, I think Apple has a lot further to fall. And if Apple falls a lot further, it's going to pull a lot of stocks with it. That's the issue. Apple pulls the entire markets with it because it's such a big weight. It also pulls the perception of the market down even more, okay? And so I don't think that's going to be a good situation at all. I think, like I said, I would not short Apple stock. I'm not going to buy put options or something like that. But I think I am not confident in Apple at all for their next year or two. At all, okay? Here's the deal. One is, from my understanding, they don't have any game-changing products coming over the next 12 to 18 months, okay? So basically they're going to come out with their new, iPhone and all it's a little better than the last one and all those sorts of things. But everything's been fine and dandy when it comes to that. When you had all that stimulus money pumped out there, right? And you were forcing everybody to be at home, and everybody was ordering computers like crazy and iPads like crazy, and hey, I got my stimulus money, why not go ahead and buy a new iPhone and things like that, right? But now everything is about to work against Apple. Everything that was working for Apple is about to work against Apple essentially, okay? And I'll tell you about how bad I think their numbers are going to get in just a moment. Europe is likely headed toward recession, right? Inflation's out of control over there, and I think whatever happens in the States is going to be way worse in Europe. China's a mess. Let's just put it like that. The U.S. has no more stimulus money. Consumers are already getting sliced and diced from inflation, so they have way less money. Apple is so big nowadays that everybody's basically an Apple consumer in the United States. I won't say everybody, but a lot of people are, right? And so back in the day, if the wealthy were doing fine, then Apple could do fine. But Apple's way too big nowadays. It's counting on the middle-class consumers who are to go buy that new $1,000 iPhone, $1,200 iPhone. And I just don't see those numbers being put up. And so as far as how bad I think Apple's numbers could get here, okay, analysts are expecting, and remember these numbers here that analysts are expecting, because I think they're going to probably bring down their numbers as this year transpires, and they'll bring down next year numbers. So remember what is up here right now, okay? Screenshot these numbers, because I think they're going to bring these numbers down throughout the year, okay? But essentially, current year, analysts are projecting the company does $394 billion in revenue. I think Apple's going to be lucky to have any growth. I'm talking 1%. If Apple has 1% revenue growth, that's a miracle. I'd call it a miracle. I think it's very possible their revenue is going to go negative, especially in the back half of this year. I don't think it's going to be good, man. I really, really don't. And like I said, from my understanding, they don't have any game-changing product coming. And the way the consumer's being hurt right now, I don't think there's anything Apple can really even do about it. I'll be honest. I think it's out of their hands. Next year, the company's expected to grow 5.6% to 416 revenue. I don't think they're getting anywhere close to that. I think it's a possibility that revenue could be negative for the company in 2023. Negative. Okay? And so we could end up, essentially everybody's baking in these unbelievable numbers for Apple and all this growth and things like that. And I really think it's possible that Apple shrinks revenues. And if you're talking about an Apple that's shrinking revenues, it will pull down Apple stock. It will pull down the S&P 500. It will pull down the NASDAQ. It will pull down the entire market, right? And so, especially for bigger stocks specifically, right? And so I've always looked at Apple as kind of like the last leg to fall. We've seen a lot of these safety stocks start to fall, the Targets and the Walmarts and many others. Apple has started to fall, but I think, honestly, I truly believe it has a lot further to go. And I kind of hope for the stock market's sake I'm wrong on that. I just don't think I am. And I don't think they're getting anywhere close to those numbers. Now, Tim Cook, I'm sure, is going to try to blame it on a bunch of different things and supply chains and this and that, but I think they're going to have a demand issue for the next 12 to 18 months. I really do, okay? Now, in terms of my advice to investors out there, I remember watching a pretty good documentary, if I recall, it was on HBO or something, and it was on Tiger Woods. Maybe it was Netflix, I don't know, HBO, something like that, a while back, and that's his dad, Earl Woods there. And I remember watching he was kind of training Tiger, to putt. And what he would do is he would go around the green and try to distract Tiger and mess with him and like hit his club and, try to distract him, right? And the reason he would do that is so Tiger learned to just really like focus in on this like one thing and kind of push out anything else that's going on, right? And so my advice to all investors in this sort of market where, you got a lot of bad news going on, I mean, a lot, you've got a lot of conflicting information and conflicting data that's erring to the side of bad, right? So my advice to folks is don't change your investing philosophy based upon any bad news or good news in the short term. Invest the way you're planning on investing, and regardless if you think the market's going to go up, the market's going to go down, make the buys you want to make for the long term. Don't get caught up into, it's fun to watch it all play out and keep track of things and, unemployment just did this and, inflation data just came in at this and this and that. It's fun to keep track of all that, but do not make your investment decisions based upon whatever's going on here short term in the markets, essentially. Because I'm telling you, if anything, it's probably going to get messier with the information before it gets better. And if you start caring too much about you start making your decisions based upon the news cycle, you're going to make a huge mistake. And we saw this play out in 2009, where investors were not at all prepared for the bottom of the market. And the same thing happened in March of 2020 as well. And when the markets flipped, a lot of people could not believe it, and they didn't want to invest for, a long time after that, right? Especially after 2009. They were like, no, it has to get worse. Like, the stock market has to go down more. Look at these companies' earnings are still so bad, and the news and the unemployment, and look at how many people are on food stamps and this and that. And market just did its thing. And so it's fun to pay attention to it all. It's fun to watch it all play out and keep track of it all and be informed. But you need to cut it off when you're starting to make your investment decisions for the long term based upon short term stuff that's happening. That's my advice to everybody. Don't do that. If you love some stock, heck, even Apple. I spoke about Apple, and I think it could go down a lot more this year. But heck, if you think Apple's going to 250 or 300 over the coming years, and the stock's 148, you got to pick up those shares. Like, that's what you got to do. If that's the way you view it. Don't get caught up into what the numbers can be short term and things like that. Like I said, it's fun to pay attention to it all, but don't start making short term decisions with long term money. Okay. Hope you guys enjoyed this as always. Thanks so much for joining me. Make sure you get that deal from FTX US. That will be pinned comment down there. And once again, don't forget to use the referral code Holy Smokers. Much love and have a great day.